In my last video, I drew my ethical lines, the companies I'll never own, no matter how good the numbers look. But passing my ethics screen doesn't earn a company my money. It just earns it a place on the list. Because a business can be perfectly ethical and still be a terrible investment. Overpriced, drowning in debt, barely making a profit. So this is my second filter, the financial one, and it's where most of the list gets eliminated. My financial screen has two stages, and they do very different jobs. The first is a set of hard knockouts, pass or fail health checks. I think of them as vital signs. Fail even one, and the company is out. I don't average them, and I don't make exceptions. A single failed vital sign ends it. The second stage only happens for the survivors. That's where I stop asking, is this company healthy, and start asking, is it a good buy, and how does it rank against everything else that made it through? Stage 1 protects me from disasters. Stage 2 finds me the winners. Stage 1 is 7 vital signs. I call them that deliberately, because like a doctor, I'm not looking for brilliance here. I'm looking for signs of life and stability. Is the business profitable? Can it pay its bills? Is it buried in debt? Can I actually trade it? Has it been around long enough to trust? Every one of these is binary, a hard line, no shades of gray. And the logic is simple. The surest way to make money is to first avoid losing it. These 7 filters throw out the fragile and the bankrupt in waiting before I waste another minute on them. And don't worry about where all these numbers come from. I'll show you how to pull every one of them for free later on. Let's go through them. 1. Operating margin. The company must make a real profit from its actual operations, and it must be positive right now, in the latest 12 months. Not used to be profitable, not profitable if you ignore certain costs. Now, 2. The current ratio, above 1.2. For every dollar of short-term bills, it needs at least $1.20 of short-term assets to cover them. Below that, one bad quarter turns into a cash crisis. 3. Net debt to EBITDA, under 4. This is my leverage line. It asks how many years of earnings it would take to clear the debt. More than 4, and the balance sheet is too fragile for me. One downturn, and it's the lenders, not the shareholders, calling the shots. 4. Average daily trading value, above $1 million. This one isn't about the business, it's about me. If a stock barely trades, I can't build a position or exit one without pushing the price against myself. Liquidity is freedom. 5. Listed for more than 3 years. I want a real public track record, how management behaved, how the numbers held up, not a freshly hyped IPO with one glossy prospectus. 6. A market cap above $300 million. Below that, the risks pile up, thin coverage, wild swings, easier manipulation. And 7, maybe the most important, a profit in at least 4 of the last 5 years. One good year can be luck. 4 out of 5 is a pattern. It tells me this business knows how to make money through a cycle, not just in a boom. Everything that clears all 7 is, by definition, financially healthy. But here's the trap. Healthy is not the same as a good investment. A rock-solid, wonderful company can still be a bad buy if you pay too much for it. So stage 2 doesn't ask, is this a good company? They've all passed that. It asks, is this a good deal, and how does it stack up against every other survivor? I score each one across 6 dimensions, and I weight them on purpose because I'm a value investor. Valuation carries the most weight by far. I would rather own a good company at a great price than a great company at a merely good one. Dimension 1, valuation, 35% of the score. This is the heart of it. I'm hunting for cheapness, measured several different ways, so no single number can fool me. Price to earnings, but always against the company's own sector, because a PE of 15 is expensive for a utility and cheap for a software firm. So I compare like with like. A PEG ratio under 1, so I know I'm not overpaying for the growth I'm getting. EV to EBITDA in single digits. Price to book and price to sales, again versus the sector. And free cash flow yield above 5%. Real cash the business throws off, relative to its price. And I measure cheap against the whole industry, including the companies I'd never buy, because competitors set the market price whether I approve of them or not. Dimension 2, profitability, 25%. Cheap and bad is a value trap. I want cheap and good. So, return on equity above 10%, return on invested capital above 8. Is management actually turning capital into profit? Healthy gross and operating margins. And margins that aren't quietly shrinking 3 years in a row, which is often the first sign a business is losing its edge. Dimension 3, the balance sheet, 15%. The knockout already removed the dangerously indebted. This rewards genuine strength. Low debt relative to equity, comfortable interest coverage, a solid quick ratio. And a company sitting on net cash earns a bonus, because cash is optionality, and it survives things that sink debt-heavy companies. The last 3 dimensions are the supporting cast. They refine the ranking, they don't drive it. Growth, 10%. I want earnings and revenue trending up over 5 years, and some growth expected ahead, but as a value investor I'm not chasing it, so it's weighted lightly. Quality, 10%. Things like meaningful insider ownership, management with their own money on the line, and a healthy free float. And technicals, just 5%. Is the price above its long-term averages? Is it not wildly overbought? That's purely a tiebreaker and a timing nudge between 2 otherwise equal names. I never let a chart overrule the fundamentals. Add it all up, 35, 25, 15, 10, 10, 5, and every survivor gets a single composite score. Then I rank them and split them into tiers. Tier 1 is my high-conviction shortlist. The names where strong, cheap, and safe all line up at once. Tier 2 is worth a look. Tier 3 is a watch list. But I want to be crystal clear about what this score is and what it isn't. It is a ranked shortlist. It is not a buy signal. No company earns my money on the strength of a screen alone. The screen's only job is to take a huge universe and hand me a short list of genuinely promising, genuinely affordable, ethical businesses worth the hours of deep work that come next. Now, I know how all of this can sound. Like it takes a Bloomberg terminal, a finance degree, and a team of analysts. It doesn't. Every filter and every metric I've described, I pull from free, public data, the kind anyone can access, and I lean on a few simple tools and a bit of AI to gather it, crunch it, and rank the results in minutes, not days. And I won't just claim that. In a coming video, right after I walk you through a full, real example, I'll show you exactly how to build this same screen yourself, step by step, for zero cost. You don't need money to invest wisely. You need a method. So that's the financial screen. Ethics decides what I'm allowed to own. These 7 vital signs and 6 score dimensions decide what's actually worth owning. What comes out the other end is a small, ranked list of clean, strong, sensibly priced companies. So what's next? Before we go deep on valuation, I want to show you the whole system actually working on a real example. I'll take an entire industry, run it through the ethical screen, and then this financial screen, from start to finish, and we'll see exactly what survives. After that, we get to the deep valuation, what a business is truly worth. If you want to follow along and build this discipline into your own investing, subscribe and turn on the bell so you don't miss it. And tell me in the comments, which of these 7 vital signs do you already check? One important reminder, everything here is for education only. It is not financial advice and not a recommendation to buy or sell anything. I'm simply explaining my own framework. Always do your own research, and if you need advice, speak to a licensed professional.